deflation is doing a lot of dirty work right now. I mean, we're seeing home prices fall at the same rate that they fell the month that Lehman went down right now. I mean, the wrecking ball, I call it compression. We write about this compressed cycle all the time at Quill. I've never seen anything this fast. I was schooled when I was inside the Fed about lag, and they drill monetary policy works through the economy with an 18 to 24 month lag. That lag time has been decimated. Decimated. You've never seen monetary policy go to work in the economy as fast as what you're seeing right now. And he is destroying demand left and right. You have to think back to what we were talking about a year ago, right? And that's, where the hell is the Fed? Why are they still growing the balance sheet? Why are they still engaged in quantitative easing? Why are they still at the zero bound? Why? Right. I mean, that was just a year ago. They just started this in March, people. March. And, judging from the H8 that came out after yesterday's close, quantitative tightening is up and running and going. I mean, all the little conspiracy theorist people on my Twitter feed have vanished and gone away. The people who are like, they're not doing it. They're not doing QE. They're still doing QE. They're like really crickets right now. Crickets. Yeah. Because quantitative, and if you go around the globe, like it's $750 billion a month that's being pulled out globally. But so how far do I think they'll go? How far do I think they'll get? I mean, it's not every day that you're like, oh, the yen was 152 a few hours ago. Now it's 147. I mean, shit's happening. I'm going to paraphrase. A lot is happening. And we're watching Treasury liquidity dry up in real time. It's not normal to watch the benchmark 10-year Treasury yield move 15, 20 basis points in a trading day. So the market is starting to tell, and the Treasury is getting involved. They're taking comments. They're talking about buying off the run Treasury securities, trying to fill some of that liquidity gap in with higher bill supply. That's coming because that's actually out for comment. So the Treasury is in the background. I think I'm going to quote a buddy of mine who I can't name, but I think Summers is coming. I think Yellen is out. I think we're going to have an appropriate person who understands markets running Treasury pretty quickly here. I mean, we're just a few days out from the election, so just give it a few days. So because you need Steve Mnuchin's, he's no choir boy, but he was the appropriate person at the time when QE blew up, even if he was by poolside in Cabo, chit-chatting with his buddies at the biggest bank saying, we've got a problem. But you cannot have a Janet Yellen in her position right now for what's to come. But you can have a Larry Summers, and I'm no big fan of his either. So I think what people are missing in the employment narrative is that there's a pattern to your typical layoff cycle. It usually starts at the bottom of the income ladder. Well, that's where people are still, look, the food stamp program had a 25% hike in October of 2021. It just got another 25% bump in October of 2022. So there is still massive stimulus money flowing through the economy, keeping the lowest paid worker out of the workforce. Yeah. But, Facebook's going to lay off 12,000. Snapchat, all of these layoffs are not figments of our imagination, but they come with golden parachutes. They come with severance. Why would they manifest in initial jobless claims, for God's sake? People are getting, when Snap announced its earnings that took the stock down, whatever it took the stock down, 27% in after hours trading yesterday. I don't know where it's trading today, but 155 billion of their 155 million of their $360 million loss was for severance. So these are all one time. We're not seeing it though, because the money's flowing to the former employees. So you're not going to see that show up in unemployment. You're just not going to see it. You shouldn't yet. However, the state of Indiana, I promise I'm not going off on it. Maybe I am, but the state of Indiana has the highest concentration of manufacturing in the nation. 28% of Indiana's gross state product is manufacturing. It is the not in Illinois, not Michigan, not Kentucky, not South Carolina, even though South Carolina is up there as well. South Carolina and Indiana have consistently had, compared to the rest of the country, rising initial jobless claims. When you drill down to the state level, we've seen it week after week after week. And it's telling you that the equipment manufacturers, that machine tool, all of these indices are gapping down at record paces. The Philadelphia Fed 6-month outlook. This is the beginning of your manufacturing pipeline, right? This is the chemicals hub in New Jersey.
Yeah.
Basically. That's why everybody pays such close attention to the Philly Fed. It's been around since 1968. It's got the longest history, but B, it's at the beginning of the manufacturing process. We've never seen a 6-month outlook where it is. Not in 1980, not in the great financial crisis, never. The data that came out yesterday is unprecedented. So the layoffs are coming, but I'm going back for a third time to your rubber band. It's going to be an unemployment rate shock. A massive pivot could reverse the wealth effect. Look, your top 5% of income earners are responsible for 23.4% of U.S. consumption.
Yeah.
So if you want to make them richer and keep consumption going, because a GOP-led House of Representatives ain't going to do it. So the stimulus money's gone. And that's something that so few people are factoring in to their 2023 narrative. It's that there's no more free money coming out of Washington, D.C. I mean, Biden's like, look, the deficit's going to come down. And I'm like, you bet your ass it's going to come down. But not the way you want it to.
Yeah.
But that's been a huge support for this economy, is what's flowed into people's checking accounts, directly deposited.
Yeah.
That's bye-bye. Adios. So for the Fed to engineer a soft-ish landing, they would have to do full-blown pivot right now. QE starting back up. We're taking rates back down to the zero bound. The stock market can go haywire, and we're going to reverse that 20, whatever it is, that the hit to your portfolio. And by the way, we've never also seen $1 million plus home sales fall like they are right now. So wealthy people right now, they're feeling it in two places, and they don't like it. The things that I'm hearing on the ground, we've lost clients in the furniture industry who are like, thanks, we were prepared, we fired everybody, and now we can't afford your subscription anymore, bye. So it's what's happening in the furniture industry is it's your canary.
Yeah.
Your Restoration Hardware CEO, he was the pioneer. He was the first several earnings seasons ago to come out and say, there's a problem here, people. And that's exactly what freight told you also in March of this year. And what's happening in freight is also one of your leading indicators, and it's a bloodbath. I mean, you've heard from some of the largest publicly traded firms saying, we're looking for Christmas because we can't find it. September is peak freight season. Wow. And they're like, we've never seen a holiday season like this where we don't have demand for freight.
Crazy.
So, I mean, yes, the Fed could engineer a softest landing. If you want to find a glass is half full, Jay Powell could have like a lobotomy tomorrow, pivot, start QE, and take interest rates negative. So Paul Volcker, who is Jay Powell's idol, his hero, his mentor, and people forget that Powell was Undersecretary of the Treasury in the 80s. He knew Volcker personally and really did admire him. But when Paul Volcker was head of the New York Fed, he didn't care about Wall Street. He was a wrecking ball every day of the week.
Yeah.
There was no Fed put then at all. And this is from the head of the New York Fed. And then he went on to be chair of the Fed in Washington, D.C., and took a huge pay cut to do that. And think about that. His wife had to go back to work. Paul Volcker's wife had to go back to work when he took the job in Washington, D.C. Flip side of the coin is Jay Powell's worth $150 million.
Yeah, I was going to say he doesn't have to do that, right?
He doesn't, but he also doesn't need the job.
Yeah.
So Paul Volcker went to serve his country. What if Jay Powell's serving his country? And in doing so, breaking the mindset of the Fed put. Powell's not an idiot. He can see in real time that home prices are falling. He can see that we've seen this biblical reversal in used car prices, down 10% year over year. He can see all this for himself. And I think because he was so burned by transitory and a staff that led him down a very, very dark, bad path with their modeling, you can make the case that he's also taking outside counsel. So he knows that the Fed is indeed destroying the inflationary impulse. He knows that the housing is going to come through with a lag. So if he knows all this, then why is he still as aggressively tightening as he is, unless he wants to seize the opportunity to initiate a new generation of traders and investors and let them know what the world looks like when the Fed makes monetary policy for the good of the US economy in the long term, as opposed to Fed making monetary policy in a reactionary fashion just to make sure investors don't lose any money. Because that's the world that 40 years of investing since Alan Greenspan came around, that's what traders and investors, that's why everybody talks about the pivot all the time, because that's the only thing we know. Modern day investors.